The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey.
The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930, toll free at 1-800-616-9236, and cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and we're going to give you some really good news about a recent big change in the New York State tax law, plus a whole bunch of other stuff, which will make you money and reduce your tax liability and make you smarter than the average bear. Anyway, I'm Esther Gulius, the Tax Lady from EG Tax. I have my buddies in studio with me, Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday to you, and Christopher Fabian.
Hello, Esther.
Hello, Christopher. You got to put that teeter hanger together, right, this afternoon?
Finish. One more piece.
Yeah, I'll tell you. I had a bad back. I've had a bad back for a long time. And I have an inversion table. And so Tiff had a bad back, and I said, let's get you an inversion table. So I think that'll help.
Yeah, I went to...
and you don't want to hit your head on the floor.
I went to the chiropractor, and I disgruntlingly, and it was wonderful, and I feel so much better. So
Good,
very
see?
thankful. Very
Listen
thankful.
to your mother.
Yes.
All right. I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. By the way, somebody keeps hacking my Facebook page. I do not have a car for sale or any tickets to see
Taylor Swift.
Taylor Swift. Nope. I'm not selling anything but income tax. That's it. That's what I sell, and that's what I do. Anyway, and speaking of that, our fall seminar in October is coming up, where we will work with you to create a budget, help you with your budgeting information, how to get money out of your investments tax-free, some tax planning. And so that's an absolute free seminar we have, and you can register at our website at egtax.com. And our tax school also is in October, right?
Right. Starts middle to the end of October, goes through to the middle of January. You learn, like we say, A to Z, stuff you want to know, stuff you don't want to know. We make sure you learn it all. And the best part is you can get a job after it.
Right. And then sometimes, you look at this thing and you go, I can't believe they just keep giving away money. And that's what's in the code, just like you're a foreign country. They just keep sending you money. So, but we want to make sure that you know how to get that money, right?
Yep.
That's right.
And so that's part of what we do. All right, brand new thing that just happened this week. Our governor signed it into law. And so if you have children under the age of 17, you can be very excited, right?
Right. As long as you filed your return by the due date or filed an extension, you will be getting this bonus money that they're going to start sending out to people in this month in August.
Must be an election year. Sorry.
But you have to have income, adjusted gross income, New York State under $110,000 if you're married, filing a joint return. If you're single, it's $75,000. Now that's very interesting, the 75. Don't you think that's interesting?
Right,
Because
it's not double.
Let's say you're a married couple and you make $120,000. Do you get the $330 per kid?
No.
No, but if you were two single people living together, both making $70,000, that's a $140,000 household. You're both going to get that if you have kids.
Right.
Correct.
Right? There's the marriage penalty in full effect.
Correct. As usual.
I noticed that right away. I thought, they wonder why nobody gets married anymore. Everything is working against people to get married.
Mm-hmm. Yep.
Right? It ought to be that if you're married, it's $150,000, and if you're single, it's $50,000, right? But that's not the way it goes, or even half of $75,000. I mean, that's the way it ought to be.
You
So,
gotta go
but
against
you
the
will
grain.
get that money. There's nothing you have to do. They're going to send you the money through the mail. I'm assuming they're going to deposit it. Don't you think if they have direct deposit?
They say it's just they're mailing out checks.
Okay.
So
All right.
make sure, hopefully you haven't moved. If you did, you may want to call New York State and
So,
update
I
and
your
you might
address.
want to do your tax return if you haven't. Or,
That's true. That's true. So it's up to $330 per kid under the age of 17.
That can be a lot of money.
It is. You figure you got 4 kids under the age of 17, you got like $1,300 coming back.
Right, right,
mean,
right.
that's
If only my niece,
tax-free
who
money.
has 6 kids, 7 on the way, lived in New York, boy, she would be almost $2,000.
And New York takes care of people like that too, right?
it does.
All right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. I want to talk. This week we already had it planned that we were going to talk about New York State. New York State has some remarkable credits and remarkable deductions, and if you don't know it, you can file a mathematically correct tax return, and they'll know that you're entitled to a credit, and they won't give it to you.
That's right. Nope,
So,
they're
but
not
we're
going to
gonna
notify
tell you about it, right?
Yeah, they're not going to notify you and let you know that you're leaving money on the table.
And then here, all right. So the highest, the taxes with the highest tax rates. California is 13.3% on income over $1 million. Hawaii is 11% for income over 200,000. That's big.
That's another
New
reason.
York State is 10.9% for income over $1,077,000. New Jersey's 10.75% over with income over $5 million, and Oregon, whoever thinks of Oregon, right? 9.9% for single people with income over 125,000. So that's a lot of money,
That is.
right? All right, let's go to the phones. We have Tom holding. Hi, Tom. How can we help you?
Yes, I'm 67 years old. I was just moved from Social Security disability over to Social Security. I get $1,750 a month. I just pulled $5,000 off the table from my IRA. Do I have to pay a tax on that?
All right. So you have any other source of income besides the $1,750?
I do. I got $150 a month in interest for a savings account, and I got $750 a year for a CD.
And you're single or married?
I'm single. I live at home, and
All right. So you're getting $1,750 in Social Security. So that's $21,000 divided by 2. So that's 21,000. I hear people in the background. Maybe you want to. Whatever. So you don't. 10,500 of your Social Security is going to be taxable.
No.
With the
No.
17, you get
No.
17. What does he get?
No,
$1,800
none
a
of the
year?
Social Security is going to be taxable.
Yeah. So and so he's not going to pay any taxes at all.
Right.
Correct.
So you're good to go.
all right, thanks.
Thanks, Tom.
Yay!
right,
Good
bye.
news.
All right. Well, let's talk to my friend down in Atlanta, Georgia. Actually, he's outside Atlanta. Larry. Hi, Larry. How you doing, sir?
Well, hello, Miss Esther, darling. You sound as beautiful as ever. I can say, but
Well, thank you. my voice will just transfer to my body. You know. But anyway, Larry.
Okay, first, very quickly, I want to thank Brother Chris, for helping me get my tax return. It came through finally. Very quickly, I got a letter recently from the IRS, bill letter, saying that they had to resend my refund for 2022. I took care of that, but just goes to show you how slow they are. Esther, I'm
Yeah.
taking this into my home the next couple of years, so I try to keep track of my expenses, but I'm not really clear on what home improvements are acceptable. For example, in the past couple of years, I installed a couple of new interior doors and locks, new window covers. I'm getting new appliances like the refrigerator, dishwasher, range, etc. Are all of those acceptable as legitimate expenses?
All right. So bust Larry's bubble here.
Well,
guys.
when you sell your house, are you leaving your refrigerator and your stove, all those new appliances, are
Yeah.
you leaving them in the house?
Probably yes.
Okay. And what type of profit are you looking for when you sell your house?
Chris, I'm not sure what do you mean. What do you mean? I'm sorry.
Well, what did-
After you sell your house, when you sell your house, let's say you sell it for $500,000, and your cost was $300,000, but you put $50,000 in improvements. So your adjusted basis would be $350. $350 from $500 means your gain would be $150,000. That's what he's asking. What kind of gain do you think you're going to have?
Oh, Esther, I have no idea. I'm right now. I'm just trying to track my expenses.
Okay, well, here's the thing. Here's the thing, Larry. You're a single guy, right?
Yes.
The first $250,000 of gain is tax-free.
Yay.
So all of those improvements that you put into your home, if it wasn't rental property and your gain is under $250,000, are going to be tax-free. So therefore, none of those expenses you put in are you going to get any bang for your buck. However, let's say your gain is $300,000. All right, then and your adjusted basis, let's say, is whatever it is when you take a look at your original cost plus your improvements. At that point in time, if your gain is over the $250,000, that's where those improvements would come into effect. But if your gain is $250 or under, you're going to get no benefit for those.
So
those expenses.
You're very wise for keeping track of everything. Very smart.
Guys, fast.
But we can work with you, Larry. Just call us, and we'll look at everything, and we'll come up with an adjusted basis to give you an idea.
Miss Esther, as always, love you much. Thank you so much.
Thanks,
Continue
Larry.
to keep track of everything. Very
All right,
good.
I'm Esther Galias, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930. We're going to take a short break. We'll be back with all the deductions and credits for New York State, at least a lot of them. Hi, we are family. I think of you as family, and that's how we want to treat you at EG Tax. And I'm sure many of you that have dealt with us, you know that's actually how we feel about you. So anytime, and even if you're not our client and you have a problem or a question, just give us a call at our corporate headquarters at 632-7886 Monday through Friday, or go online at egtax.com. We are there for you. Don't just get a bill and pay it, because many of those, if not all of the bills, can be modified or are partially or totally incorrect, right?
That's right. That's right.
I wanted, I was just got my computer up here. There's a really great rate at 5.4% on a 12-month CD at Eagle Bank. And that's for 1 year. If you do 6 months, it's 5.38%. Eagle Bank, FDIC insured. So I just saw that, so I wanted to pass that on for those of you that are looking for high yields.
And on our website, we always post the best interest rates.
But
which
I
is
just
really,
got this. It just
I know.
popped up.
Yeah.
So this is
Cool.
brand new.
Cool.
Okay, I wanted to talk about New York State taxes. And you can see when we talked about before, 10.9% is the top rate in New York State. New York State is not a cheap place to live unless you fit into some categories, and that's part of what we're going to talk about today. But New York State will assess you additional income if you have income from municipal bonds that are outside New York State. So if you invest in muni bonds out in Oklahoma, that's tax-free on the federal, but on New York State,
Taxable.
got to add it back in, right?
Yep.
Even though alimony on post, what year is it, 1990 divorces?
2019.
2019 divorces are completely tax-free on the federal. On New York State, if you're receiving alimony, that's an add back to income.
Yep, it is, which gets very confusing, but it is.
And the other thing is, if you're using any kind of accelerated depreciation, or you took advantage of some of the more liberal depreciation on your business returns, that also can be an add back on New York State. So that's just a few of them. But let's concentrate right now on the subtractions. So public pensions that you get, regardless of your age or the amount you receive, what happens to that?
Those are completely tax-free on the state of New York. New York State is very kind to those individuals. Yay.
But let's say that you have been including that on your tax return for New York State.
You'd want to amend it.
Yep. You can amend it for the last 3 years and get some money back from them.
Right. But if you've been doing this for 10 years, you can only go back 3 years.
That's the
so,
statute of
but it's
limitations.
very important that you stop doing that and you amend the return, and you'll get your money back from New York State. If you're retired, and this is state only, if you're retired on a municipal pension, so that would be a public pension, so that'd be a municipality, county, state, or federal.
Yep,
Right.
that's right.
Right.
And the statute of limitations is 3 years, so you can amend the last 3 years. And like you said, stop it, right?
Right, make sure, right. And then now, if you're over the age of 59 and a half, regardless of your pension or IRA, that's also a subtraction on New York State, right?
That's a $20,000 per taxpayer on the return subtraction. So if you're married and you had $25,000 worth of a pension, you get a $20,000 subtraction, so $5,000 is taxable, and then your spouse has a pension of $18,000, even though she has extra as of a subtraction, it doesn't flow through to the taxpayer. It's per person, so they would have a subtraction of $38,000 from their tax return.
But if they both were having pensions of $30,000 apiece, they'd be able to take
$20,000 apiece, so then
right,
they'd pay
$40,000,
Yep.
right? And again, if you've missed this deduction, and there are countless people that miss this deduction, and do you think that they know in New York State that it should be coming off?
Maybe, but they're not going to let you know.
But I mean, they know you're over the age of 59. If you're, over 59 and a half, they know.
They know.
But anyway, you can only amend the last 3 years' returns. And so you'd make sure that you fix it as soon as possible. The other thing is Social Security benefits.
Completely tax-free on the state of New
Completely
York.
tax-free in New York State.
New York State is kind to retirees.
Right. All right, and then one of the other big adjustments to income is Startup New York wages. There are companies that started in business in enterprise zones or in urban areas, and the state of New York basically has said that the employees don't have to pay New York State taxes on their wages.
Yep, which is really great. I've seen employees like this, and when they get their W-2, there's no withholdings, and so essentially every pay period they're getting more money in their pocket, which is really great for those staff members.
Absolutely. So again, and if you're an employee who has been working for a company that is Startup New York, and you haven't been taking the subtraction of your wages, you have substantially overpaid.
Right. But you got to make sure your W-2 in box 14 has SNY and the dollar amount. If that's not in there and you take that subtraction, New York State's going to say, nope, I don't think so.
They're gonna
Yeah,
want
but
proof.
but many do-it-yourselfers don't know this, right?
Right.
So just want to make, all right, now, 529 plan contributions. Let's talk about that. What is a 529 contribution, and why is that so good on New York?
That's a college savings program where you can put up to $10,000 a year, and it saves money for college and also K through 12. You can use it for those schoolings too, which is a great thing. And so you get an adjustment to income if you put that money in up to $10,000 a year if you're a married couple.
Now, do you have to go to college yourself?
No.
I mean, when you're
be,
contributing to the 529, maybe somebody's listening and they say, I don't want to go to college.
No, this is for your dependents. So you would be the account holder and your beneficiary would be the one who uses the money for their college.
So could grandma and grandpa open 529s for their grandchild?
Yes.
So that doesn't have to be their dependent, it's just their beneficiary.
Correct.
Right?
Correct.
So, I mean, what a great thing to do, like at Christmas times, birthdays, put money into the kid's 529 plan.
And make sure,
And you
though,
get the deduction.
make sure, though, it's a New York 529.
Explain why, Chris.
Because if you put into Pennsylvania 529, New York's going to say, that's not us. You don't get the subtraction. So, and they do monitor the money that goes into the New York 529. So they will catch that if it is not a New York 529. But like you said, grandparents, well, we just talked about their pensions may be tax-free, their Social Security's tax-free, or if they're non-government, the first $20,000, they may not pay tax to New York. So if they're planning on putting money in a 529 for their grandchild, are they going to save money?
No.
No.
But so that's when the grandparents might want to give that money to the parent, who would then be able to take it as if they make the contribution to the 529 using grandma and grandpa's money. Right?
Right,
Mom and dad would take the deduction.
right.
Okay, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We want to talk about federal income from U.S. obligations, which would be like savings bonds, U.S. savings bonds, or any kind of U.S. obligation. That's taxable on the federal, but how about on New York State?
If they're federal, no, they're not taxable on the state.
Right. So that would be a subtraction. So even though you had U.S. savings bond interest that was taxable on the federal, on New York State, you take that as a subtraction. All right, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break for the news, and we'll be back on the other side with your questions, comments, and texts. All right, family, this is Esther Golias, the tax lady. We're talking New York State. I'm going to tell you many people that are listening have been overpaying their New York State taxes. Now, it's true, they're not as much as the federal, but they're very substantial, and I wouldn't want to overpay by $1,000, you know. So part of what we want to help you understand is there are lots of subtractions, lots of credits, many of which are completely refundable, but if you don't put it on your tax return, they're just going to let you overpay. So I'm joined in studio with Tiffany Fabian, Christopher Fabian, and I know we got a text, but I wanted to mention the Native American income as a subtraction. What does that mean?
Well, if you are Native American and you live and work on the reservation, your income is totally tax-free in New York State.
Isn't that cool?
Yep.
Yes.
That's cool. And then how about, what's the health care bonus income mean
Well, that was
when you're a healthcare worker?
that was the COVID bonus healthcare workers got for working either part-time or full-time, and it was up to like $3,000, and that was a subtraction on the New York return.
Right. And if you didn't take it off, so if you're a healthcare worker, and that was a very broad reach, wasn't it? I mean, it wasn't just if you were a nurse. I mean, if you're an EMT, and you got a bonus for serving during COVID. Some employers gave that whole bonus to you in 2022, and some of them split it between 22 and 23, and some of them just put it all in 23. So if you never took that off, that's a subtraction on the state of New York, and you get money back.
Yep, because they included it in your federal wages, so it was up to you to subtract it off New York State's wages.
Right, and then and there is, on that one sheet with subtractions, there are tons of subtraction, but they're very obscure, some of these other subtractions. But here's another one: payments to volunteer firefighter length of service award. How does that work?
Yeah, so if you are a volunteer fireman and you work or volunteer for a fire company that participates in the length of service program, they give you a pension after you're done volunteering, and it can be up to like $6,000, $8,000 a year. And so the nice thing is it's tax-free on the state of New York. But again, like you said, you have to subtract it. And if so, some people don't know, and so they just
If
pay
you
New York
don't
State
know,
taxes on
they're
it.
going to let you pay.
Yep.
So that's it. And again, I'm Esther Galias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We do have a text, and then I'll get into credits here.
Yep. It says, "Hello, I bought a cabin 20 years ago for $40,000. If I sell it for $100,000, what do I pay in taxes? Thank you."
So it's not as easy as just saying 40 from 100, right? Because there's a lot of things that go into what's called the adjusted basis. Why don't you guys explain what that would be?
Sure. So just like when we were talking to Larry earlier in the show, did you do any improvements to it? Did you put on a new roof? Did you put it in addition? Did you change the bathroom, the kitchen? Did you put in a driveway? You know, anything you did to improve that property increases that $40,000 figure. So then you take that new figure, back away the 100,000, back that away from the 100,000, and any closing costs you had at the time of sale, and that will give you your gain that you would have to pay tax on. And that would be maybe at 15%, depending on
Or
your tax
lower.
bracket. It could be 0.
Right. So the thing is, if your income's low enough, the capital assets can be taxed at 0%. Then the next level would be 15%, but the maximum is what percent?
20.
Right. So, but now the state of New York, we are talking a lot about New York State. They give you no benefit. The federal government cuts this big slack on capital assets, sale of capital assets. The state of New York does not. And when we were talking with Larry before, we were talking about the first $250,000 being tax-free if he was single, $500 if you're filing a joint return. That would be on your primary home. That would not be the case on this cabin,
Correct.
unless it's his primary home.
Yeah.
It could be, right? Couldn't it be his
Yeah.
primary home? So
It could
anyway,
be.
I'm Esther Galias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Now let's talk about credits. Now, why are credits so good?
Well, credits on New York State, a lot of them are refundable credits, which means it's money in your pocket.
Just like what they're doing now with this child tax credit, right? They're just sending money out.
This is a supplemental, so it's not an advance of your 2024 child tax credit. That's just a bonus money they're giving you. So, then on your tax return for 2024, you will get this credit too.
Again.
Yeah.
Right. Okay, so the earned income credit, explain how that works on New York State and why that's so important.
Well, the earned income credit feeds off of the federal, and it could be up to a 20% credit
Of the federal.
Of the federal. So if you get $5,000 from the federal, 20% of that would be $1,000 on New York State.
And if you don't file your New York State return because you think you owe no taxes, they keep the $1,000
Correct.
Exactly.
because it's a refundable credit.
Yes.
Correct.
And the child independent care credit, that's basically a daycare credit, right?
It's,
How does
where
that
you're
work?
paying somebody to watch your child so you can work,
You can work.
go to
or
school,
go to college
or look for work.
Right. So how does that credit work?
Well,
Percentage.
that's a percentage of what you pay, again, off of the federal credit. So it could, it depends on what you pay and how much it could be up to.
But here's the really cool thing. On the federal return, if you have a 2441 a daycare credit and you pay no taxes, you get no benefit for it. However, on the state of New York, even though you had a credit on the federal and it did you no good, on the state of New York, it's refundable. So again, if you never included your daycare credit on the state return, you have money coming back.
It's so funny when I'm teaching a tax class and I tell that to people, their eyes glaze over because there's so many little nuances, so many things to know. And that's just another oh my God, right?
Well, when you take a look at the state of New York return, it's really equally as complicated as the federal, don't you think?
If not
because
more.
because it has because with New York State, they say, oh, you can't take that on the federal, but you can take it on New York State. So you end up doing a completely different set of rules on New York State.
Right. And, and we do all the other states, and I don't think there's one that even comes as close as complicated as New York, as any other state.
California is pretty
is.
out there,
That's true.
Anyway, another thing,
But
college
wait,
yes, sir.
wait. Sorry. One of the
Yes.
other things that Kathy Hochul just signed
I thought about that, but I didn't know if you
was
guys want to talk about
that parents, if you income qualify, aren't going to pay more than $15 a week for child care.
That's really good.
But
There's income restriction.
there is that's why I was saying if they qualify, yes. And the parents though have to they have to fill out an application to get this. It's not like this child tax credit where New York's going to just give you the money. This is something the parents actually have to fill out an application and apply for it. And then the daycare provider gets up to 90% of their cost back from New York State.
Right.
So,
But this is a brand new rollout, and I know when they did this thing with the kids, the $330 this week, they weren't even sure exactly how to do it. But one thing for sure is EG Tax will keep you abreast, so that if you are a parent with daycare and your lower income, will help you to get that cap on your daycare expenses.
right.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. All right, the other thing is the college tuition credit on New York State.
Yep. That's also a refundable credit, or it can also be used as an itemized deduction. And so it's also a percentage.
Yeah, it could be $200 on up to $400, or like Tiff said, an itemized deduction. So
On the
whichever
first 4
gives you the
years of
best.
on the first 4 years of higher education, correct? Just like on the American Opportunity Tax Credit.
Yes.
Right?
Yes.
Yep.
So that's another credit, and again, it's refundable, or you can take it as an itemized deduction, whichever is better. Then there's, and here, this is another one. There's a non-custodial earned income credit. Now, who would get that? And sometimes you can really bless a dad. It's usually a dad that would qualify for this.
Right. It's the non-custodial parent. So for the parent that the child doesn't live with, but that parent is paying child support through New York State collections.
If they're up to date. So even though they would have gotten an earned income credit if the child lived with them, this is a non-custodial parent, and if they're paying for the child support timely through the New York State collection, their income is lower, they would, even though they wouldn't get a federal earned income credit on New York State, they would give it to you.
Correct.
Right? All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're gonna talk about it. We got a great big text that just came in, so we're gonna take a short break, and we'll be back on the other side with your calls and texts. Hey, family, thank you for listening. I'm Esther Golias, the tax lady from EG Tax. Want to make sure that you guys understand, if you have a limited liability company, an 1120S, a subchapter S corporation, or a partnership, you have to register with BOI FinCEN by the end of the year if it was a pre-2024 business. If it's a 2024 business, you only had 90 days from the time you started that business. The fine is $500 per day till it gets to $10,000. So EG Tax will help you with that. Don't ignore it. We'd hate to see you have a penalty. Want to talk about volunteer firefighter credits? You guys, hello.
Yep, we're here.
Yeah.
So,
All right, so-
volunteer fire credit if you are full-time active volunteer firefighter, you get a $200 refundable credit on your New York return.
But and if you don't file a return, you miss the credit.
Correct. You don't
Right?
get it.
How about nursing home credit? This is so big.
Yes,
Right?
This
So
is
if you're
also
private
known
pay,
as
if-
the bed tax. And so, Chris, go ahead.
So, New York State, when you are a full pay patient at a nursing care facility, not an assisted living, okay, it's a full nursing home. So if you're paying the $16,000 a month, you are paying also a bed tax. And when you file the New York return, you will get most of that back. Most places now are charging 7%. You get 6% back. So New York State keeps an extra percent.
So if you're paying $16,000 private pay, you're paying $192,000 to a nursing home, and I'm telling you, if you're going to crack up the car right now while you're listening, that's what the cost is. Included is a 6% bed tax, which is $11,520 that you get back only if you apply for it, and that's on an IT 258, right?
Correct. Yes.
So that's really important for private pay patients. If you're on Medicaid, you don't qualify because you're not paying for it, right?
Correct.
Right. And, speaking of the nursing home credit, this is where people ask us, should I continue to pay my long-term care insurance? Because that is another credit on New York State.
That's a good point, Chris. Good point. I didn't have enough time to write all the credits down. I mean, there are tons of credits on New York State, and it's a dollar for dollar reduction. Some of these are dollar for dollar reduction. Some of them are absolutely just a refund that they're going to send to you, like the nursing home credit, right?
Right.
And then the IT 229.
The 229 is the real...
home property.
Yeah, the real property tax
Yeah,
credit.
that's it had started 2 years ago. It's a great property credit for people who are homeowners and who pay property taxes, and you qualify for it if your income isn't too high and you pay a amount in property taxes, and you get to receive up to $350, and it's based on
your property taxes and your income.
Right. But a lot of people qualify.
Right. And
initially, when it came out, they thought very few people were going to qualify. But if you don't file a New York return and you have relatively large property taxes, I'm not really that large, really, as compared to your income, you might have a refund coming of $350.
Yeah.
But if you don't file, they won't give you the money.
And the thing is that a lot of seniors don't have to, or people don't have to file anymore. And so this credit is just falling by the wayside. People aren't getting it, and it's
Absolutely.
a refundable credit.
And this is where, we talked in the beginning where families, low-income families are getting this extra money right now. Well, this credit, the 229, the real property tax credit, that's gone. That's done. You people need to call their senator, call Hochul, and say, we want it back.
Yeah.
Hey,
Well,
you're giving
last
it
year
to
was the
these
last
people.
year. So 2023 was last year. It was 22 and 23, right?
Yeah, 21,
So
22,
you're absolutely
23.
right, Chris. Instead of them always, and I understand giving the money for the kids, right? But seniors on a fixed income, hello,
Yep.
Yep.
right? I mean, they need all the help they can get. We have a couple texts.
Yep. The first one says, do I pay date of death capital gains on a house being sold that has been in an irrevocable trust, or is it capital gains from the original purchase price? And did the IRS change their position on this?
No, if you're in, if you any capital asset that's in an irrevocable trust, you are not going to get the stepped up basis. Now, I've had attorneys call me and say, "You don't know. Oh, we know a loophole." Well, if you know a loophole, you should talk to your attorney. But everything I've read, that if you have a capital asset inside of an irrevocable, if it's in a revocable trust, then you get a stepped up basis, but not if it's in an irrevocable trust. That was just changed last year.
Right.
Right.
And speaking of that, we do have Jeff Katz coming on next week.
Which is a great lead-in, right?
Yes.
Because he would be who you can call and say, Esther said last week that if it's in an irrevocable trust, I don't get a stepped-up basis. Well, see if he has a loophole. And I'd love to know if there's a loophole with that, because that is something that was not a problem up till last year.
Yep, that's right.
And a stepped-up basis. Let's talk about what stepped-up basis means so people understand what we're talking about.
Sure. So, mom and dad bought a house back in 1963, we'll say for $20,000. Now, unfortunately, they pass away in 2023, and you sold that house for $350,000. Well, you get the value of that house at the date of death, so you're not paying tax on that full $330,000.
So that's called a stepped-up basis.
Right. So if the house was worth $330,000 when mom or dad passed, the last person passed away, that's what you get. You sold it for that. You pay no tax. So
Correct. And so now let's just use that same example. If your parents gifted you the house before they passed away,
oh boy. So if
you
they
can see the answer to that.
Then it goes back
because
to
then
their-
it goes back to the basis of the original. It goes back to the original cost plus improvements of that person.
That's a lot of work.
And then what makes it very complicated is the original cost. If dad or mom passed away in between before they gifted you the property, then you would get a half stepped up basis.
Correct.
Right?
Yep.
So this can be very, very tricky. And so if you're somebody that thinks you're going to give your family home to your kids, make sure that you look into a life estate or give us a call, because we'll be very happy to help you. There's no charge for us to sit down and talk to you. Right?
Exactly. And
All right. And
now
then
we got
another text.
There's
here, right?
two. Yep. And Chris is going to read the next one, right?
Hi, Esther and gang, longtime listener. Enjoy your show. I live in a two-family home. I live in the lower and rent the upper. When I sell it, will I owe tax?
Yes. Probably. I mean,
On that half,
because on half of the house, when you look at a two-family house, half of it's personal if you're living in it. The other half is business because you're trying to make money. That's what I'm assuming. So therefore, you had depreciated half of the house for a period of time. When you sell it, the sale of the personal portion, if you're single, the first gain up to $250 is tax-free. If you lived in it for at least 2 years, married filing joint return $500. However, on the rental portion, you have to go back to your original cost basis, plus improvements, less depreciation, plus expense of sale from what you pay, what you're selling it for, and that will be a capital gain.
Right.
That's right. That's right. And so a really good idea is to give our office a call so you can plan on what the answer is going to be if you sell the house. And
However, if that person did a 1031 exchange on that rental property upstairs, then he wouldn't owe any taxes. He could defer it.
Yep,
Right?
That's right. Yep.
So a 1031 exchange is a tax-deferred exchange when you exchange like property for like property. So your rental for, real estate for real estate. And it doesn't have to be a piece of property that you're actively managing. It can be one that you're in a limited partnership, for instance, and have it be passive. But it's got to be like for like, and you get an exchanger to help you.
Yep. And the IRS is rumbling about getting rid of these exchanges.
They are.
And
They're
so
absolutely. Yeah.
That's
Rumbling is the word.
it's sort of you're experiencing that. We are today in Buffalo in the rain. The last question is, does memory care qualify for New York State bed tax credit?
Only if it's a qualified nursing facility.
Full care.
So
Yep.
it's got to be a qualified nursing facility.
Yep, and also has to be paid by their funds and private funds, and cannot be paid
So
for through
let's
Medicaid.
just say that, let's say, Tiff, that somebody's listening, and 2 years ago they were paying for mom's nursing home,
Mm-hmm.
right? And they never heard about the bed tax. can they get their money back?
Yeah, most definitely. They can amend the return and add the New York 258 to it and get the money back. And they should also do it for the year after that, so that we can also get the money back for that year. And then
But
going
maybe
forward,
the next year they were on Medicaid.
then they wouldn't that year.
So what I've seen is that they might have been private pay for a year and another year, and then the next year they were only private pay for maybe 4 months, and the rest of the year they went on Medicaid. In that case, they would get the nursing home credit, and a partial nursing home credit.
Yep. And there's a large text. I don't know if you want to read this, Chris.
Well, it's going to be, I'd have this person call in next week to ask Jeff this. To just have Jeff Katz speak about the limited power of appointment in the irrevocable trust, allowing you to change the lifetime and residency beneficiaries in the trust. If your house is in the trust, it is considered an incomplete gift, and thus the asset is included in the grantor's gross estate.
Well, and I do know that if it goes into the estate, then it'll get the stepped up basis. That's
Yeah.
what they think. That's what they're saying.
Great information.
So if it goes through the estate as opposed to being in the trust, then they will get the stepped up basis. And we will ask Jeffrey Katz about that next week.
I'm going
right?
to take a picture of that text and
send
ask
it to
Jeff.
him so he's ready.
So he's ready. That's a great. Somebody
All right.
knows what they're talking
All right,
about.
a couple more things before we close up the show here. You can itemize on New York State when maybe you can't itemize on the federal, because the standard deduction in New York State is relatively lower, a lot lower actually, than the federal, and a lot of things that aren't deductible on the federal anymore, such as business mileage, education for your job, training for your job, office and home, things of that nature. When you're an employee, they are deductible on New York State if you itemize. Now, if you haven't itemized, you still have those 3 years to go back and itemize. You want to make sure that you have all your receipts, so that's for sure, because the state of New York could ask for all the proof as they can.
And they do
anytime,
that.
right? Right, and they do that, right. Anyway, I'm Esther Golias, the tax lady. If you're interested in our fall Fighting Inflation seminar, go to our website at egtax.com. If you think that you might be interested in tax school, it's a really, really good course. I just was noticing here on the internet, there's one here for that you can take for $1,000. Ours is free. Good deal. Anyway, I'm Esther Golias, the tax lady. Until next week, I'm Esther Golias, Christopher Fabian, Tiffany Fabian. Thanks for listening.
The previous program was paid for by EG Tax.